a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about energy ETFs. And we know that energy was the best performing sector in 2021. And this year too, it is the only sector in the green. It is the best performing sector this year and the only sector in the green. Utilities is the other sector which is kind of flattish. Energy is up about 37% year to date as oil prices continue to rise. And we know that demand for oil has been rising for the past many months because global economies, they recovered from the pandemic. And then the war in Ukraine just supercharged that rally because Russia is a major exporter, or Russia was a major exporter of oil and natural gas. Now, yesterday, oil prices fell, and that was mainly because of these continued lockdowns in China because of their zero COVID policy. And China is the world's top oil exporter. So those concerns, there was demand concerns and a rising US dollar, those impacted oil prices yesterday. Oil commodities and dollar are generally inversely correlated because a rising dollar makes commodities expensive for many countries around the world. So that was the reason why oil prices fell yesterday, but the outlook for oil remains positive because the demand continues to rise and supplies have been disrupted because of the war. Now, as far as energy stocks are concerned, they reported record profits for their first quarter recently. According to Zacks earnings trend, energy is one of the very few sectors that are seeing positive earnings estimates revision. But despite these record profits, these companies are not increasing production. They are investing little amounts in increasing production, and that is because the world has been transitioning to green energy. There's a lot of pressure from the governments and major institutional investors like BlackRock, Vanguard on these companies to transition to cleaner forms of energy. So that is why they are not increasing production. So that is why the supply may continue to be tight. And we know that transition to green energy is going to take many years. That's not going to happen anytime soon. So instead of increasing production, these companies have been returning a lot of cash to their shareholders in the form of share buybacks as also dividends. Now, one more thing I wanted to add is that energy, because the share of energy went down in the major indexes over the past few years. It used to be around 11% about a decade ago. Now, because of continued underperformance, the share has gone down to below 3% in the S&P 500. That is why most investors have low exposure to energy because they have a lot of exposure to these broad indexes through mutual funds or ETFs. So that is why if you want to have exposure to energy, it makes sense to invest in an energy ETF so that you can increase your exposure to energy. Otherwise, your portfolio exposure to energy will remain quite low. Let's take a look at three popular energy ETFs that provide different kinds of exposure to investors. So let's go to Zacks.com to take a look at these ETFs. So the first one I'm highlighting is the most popular energy ETF. It is market cap weighted. It is by State Street Energy Select Sector Spider Fund, ticker symbol XLE. It is also one of the cheapest with just 10 basis points expense ratio, ultra popular with $37 billion in assets. So to learn more, you can use the link on Zacks.com code page. And before that, see the juicy dividend yield, and you can also read our research report and articles. So the State Street webpage for this ETF, 21 holdings, market cap weighted, so there's a lot of exposure to those giants in the space. Exxon and Chevron account for 44% of the portfolio, and then there is EOG Resources, ConocoPhillips, Pioneer Natural Resources, etc. And the second one that I'm highlighting is also by State Street, but unlike XLE, this is equal weighted. So if you don't want a very top heavy concentrated exposure, you can look at this ETF. The ticker symbol is XOP. It holds E&P companies from the energy complex, 35 basis points expense ratio, and 4.9 billion in assets. Again, you can use the link on Zacks.com to go to the external web page. You will see what it holds. So exploration and production, oil and gas refining and marketing companies, and equal weighted exposure. So you will get a very different exposure compared to the first ETF, EQT, Valero, Antero, Sinclair Corporation, Southwestern Energy. These are the top holdings, but they are almost in equal weights, and at the time of rebalancing they will again be brought back to equal weights. The third one that I'm highlighting invests in smaller energy companies, small cap energy companies. This is also market cap weighted, has an expense ratio of 29 basis points and 175 million in assets. So if you believe that smaller companies will do better, you can take a look at the ETF, and you can go to the web page, Invesco web page, using the link and see what it holds. So you will see somewhat similar companies as XOP, because XOP, because of its equal weighting, also tilts towards smaller and mid-cap size companies. So Southwestern Energy is the top holding, but since this is market cap weighted, you will see the weightings are quite different compared to XOP. Now on the next slide, I have the comparative performance over the past 1 year. So you will see that these companies have returned between 52% to 67%, whereas the S&P 500, after all the recent gyrations, is almost flat over the past year. On the next slide, I have the comparative performance this year for these ETFs and the S&P 500. So these ETFs are up around 38 to 40%, and the market cap weighted most popular ETF XLE is the best performer, and you will see that the S&P 500 index is now down a little more than 15% year to date. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer, and I'll see you next week.